Could the next US election be the deciding factor for your crypto investments? What if the outcome of one political race could send Bitcoin to the moon, or send it plummeting? Whether you're holding, buying, or selling, today's video will give you the insights you need to understand how US elections can impact crypto prices and help you make your next move. Welcome back to Wall Street Mindset, where we connect the dots between politics, economics, and your investments. And today, we're diving deep into the relationship between US elections and cryptocurrency markets. We'll explore whether elections create opportunities for investors or whether they bring risk you should avoid. So, should you be buying or selling right now? Let's find out. First off, it's important to understand how elections typically affect financial markets in general. Historically, elections tend to cause volatility. Why? Because markets hate uncertainty. Traders and investors start trying to predict how a new administration's policies will affect everything from stocks to bonds, and yes, even cryptocurrencies. Now, crypto is a relatively new player in this game. If we go back a decade, during previous US elections, Bitcoin and other digital assets were far from mainstream. But that's changed. Today, we have institutional investors, hedge funds, and even companies buying into crypto. So what happens politically can have a real impact on these assets. Let's break down how different election scenarios could influence the crypto market. We'll focus on two key factors: regulation and economic policy. First up, regulation. Crypto is decentralized by nature, which means it operates outside of the control of any one government. However, that hasn't stopped governments, especially the US, from trying to regulate it. Candidates with a strong focus on financial regulation may push for stricter rules on crypto exchanges, increased oversight of digital assets, or even a crackdown on decentralized finance platforms. If we get a president with a heavy hand on regulation, the market could experience some serious turbulence. In this scenario, crypto traders might panic, leading to short-term sell-offs. But here's the catch. The market often bounces back after these regulatory fears settle down. Take, for example, China's repeated bans on crypto. Every time it happens, the market dips, but after a few months, it's business as usual. The lesson here? Regulation might cause some immediate pain, but it doesn't always kill the crypto market. On the flip side, let's consider the possibility of a pro-crypto candidate. This is someone who believes in innovation, blockchain technology, and maybe even lighter regulations for crypto businesses. If a president like this takes office, we could see a surge in optimism. Markets may respond positively, and we could see prices jump as both institutional and retail investors gain confidence. So, if you believe that a pro-crypto candidate has a good shot at winning, it might be worth holding or even buying into crypto before the election, anticipating a post-election rally. However, if a more regulation-focused candidate takes the lead, you might want to tread cautiously, especially if you're a short-term trader. But it's not just about who wins. The election process itself introduces a layer of uncertainty into the market. Leading up to election day, polls fluctuate, headlines swirl, and markets react. Traders might start making moves based on predictions rather than facts. This means we could see heightened volatility in the crypto market as investors brace for the unknown. Think about it. No matter who is ahead in the polls, there's always the chance for a surprise outcome, just like we saw in 2016. And when surprises happen, the markets can respond with big swings. In these moments, crypto, already volatile by nature, can see even larger price moves as uncertainty drives speculative trading. So, what does this mean for you? If you're a long-term holder, you might not need to worry too much. Crypto markets tend to even out over time, and long-term investors are usually rewarded for their patience. But if you're a short-term trader, buckle up. You could see sharp rises or sudden drops in the weeks leading up to, and immediately after, the election, Congress and legislation. It's not just the president, either. The outcome of congressional races is just as important. Congress has the power to make or break any major financial legislation, and they play a crucial role in determining the future of cryptocurrency regulations. If we end up with a Congress that's pro-regulation, expect some turbulence. But if we get a mix of pro-crypto voices, the markets might feel more secure. One recent example is the bipartisan interest in central bank digital currencies, or CBDCs. Regardless of the election's outcome, there's growing momentum for the government to issue its own digital dollar. If that happens, it could shake up the entire crypto ecosystem, potentially driving interest away from decentralized coins like Bitcoin and Ethereum. What should you do? So, should you buy or sell your crypto ahead of the election? Here's the truth. It depends on your investment strategy. Are you in it for the long haul, or are you a short-term trader looking to capitalize on market movements? Let's break it down. If you're a long-term investor, the best strategy might be to stay the course. Crypto markets are notoriously volatile, but history shows that they tend to recover from political shocks. If you're confident in the long-term value of Bitcoin or Ethereum, then the election might be just another blip on the radar. However, if you're trading on a shorter timeline, you'll want to watch the polls closely. If it looks like we're headed for a pro-regulation administration, you might consider selling before the market reacts. On the other hand, if a pro-crypto candidate looks strong, you might want to buy into the optimism before prices rise. Conclusion. At the end of the day, predicting exactly how the election will affect crypto prices is almost impossible. But understanding the key factors, regulation, policy, and market sentiment, can help you make informed decisions. Whether you're buying, selling, or holding, stay informed, keep a close eye on the markets, and remember that volatility is part of the game in the crypto world. With that said, thanks for watching, and until next time, this is Wall Street Mindset. Make sure to hit that subscribe button and tap the bell so you never miss an update on the latest market trends.